December 9th, 2024. Oracle Corporation releases its fiscal 2025 second quarter earnings. Revenue comes in at $14.1 billion, up 9% year over year. On paper, this should be a win, but the stock drops more than 6% the next trading day. Headlines flood financial media. Oracle misses expectations. Cloud growth disappoints. Hyperscaler competition intensifies. Analysts open their spreadsheets. They circle the same numbers, and they argue about cloud adoption curves, market share, pricing pressure. And almost nobody asks the only question that actually matters, a question so fundamental, so uncomfortable that answering it collapses entire valuation models. Here is that question. Why is one of the world's fastest growing AI infrastructure companies suddenly unable to scale capacity at the exact moment customer demand has never been more aggressive? Oracle didn't lose customers. Oracle didn't lose relevance. Oracle didn't lose technological capability. Oracle hit something much harder than competition. They hit physics. And that collision between physical reality and financial expectations is restructuring trillion-dollar markets right now. Not next decade, not in theory, right now. And if you understand what Oracle accidentally revealed on that earnings call, you'll understand why AI infrastructure is stalling, why data centers are colliding with power grids, why battery technology suddenly matters more than software, and why silver, of all assets, is behaving in ways Wall Street didn't expect. This story is not about a missed quarter. It's about the moment the digital economy ran headfirst into the limits of the physical world. Oracle, AI, and the illusion of infinite scale. To understand why Oracle's earnings shock the market, you first need to understand what Oracle actually is today. Most investors still think of Oracle as a legacy enterprise software company. Databases, licensing, old school corporate IT. That view is dangerously outdated. Over the past 5 years, Oracle quietly transformed itself into one of the most aggressive AI infrastructure providers on Earth. Oracle Cloud Infrastructure, OCI, positioned itself differently from Amazon AWS or Microsoft Azure. Oracle went after raw performance. They built data centers optimized for massive GPU clusters, high bandwidth networking, AI training workloads, large language model development. They became the preferred infrastructure partner for companies that didn't want general purpose cloud. They wanted brute force compute, and it worked. By late 2024, Oracle had secured contracts with OpenAI. Nvidia was using Oracle capacity internally. Meta needed Oracle's GPU clusters. Elon Musk's xAI was demanding more compute than Oracle could physically deliver. Demand wasn't slowing, it was exploding, which makes what happened next so important. The earnings call that hid a bomb. On December 9th, 2024, Oracle CEO Safra Catz said something that barely registered with analysts. She stated, plainly, that Oracle did not bring online as much cloud capacity as it could have monetized during the quarter. Not because of lack of demand, not because of chip shortages, not because of budget constraints, because of power capacity. Her words were careful, measured, almost polite. But buried inside them was a structural admission. Oracle had to choose between bringing small facilities online quickly or waiting months for adequate electrical grid capacity to power larger builds. They chose to wait. That choice cost them revenue recognition. And Wall Street punished them, but Wall Street completely misunderstood why that choice existed in the first place. This wasn't an execution issue, it was an infrastructure failure. The physics of AI, why power, not chips, is the real bottleneck. Let's talk about the one thing no spreadsheet can capture: electricity. A single Nvidia H100 GPU, the chip powering ChatGPT, Claude, Gemini, Grok, draws about 700 watts of continuous power. Not peak load, not bursts. Continuous, steady-state consumption, every second, all day, all year. That's like running 7 high-end gaming PCs simultaneously, forever. Now scale that. A modest AI training cluster uses 10,000 GPUs. That's 7 megawatts of uninterrupted power demand. That's enough electricity to power roughly 5,000 American homes simultaneously. And Oracle isn't building modest clusters. Oracle is deploying 65,000 GPU facilities, planning for 130,000 plus Blackwell GPU installations. That's city-level power consumption. But cities have something AI data centers don't. They sleep. AI doesn't. Why the grid was never built for this? The US electrical grid was largely designed in the 1970s. Engineers optimized it for residential neighborhoods, shopping malls, factories with shift schedules. Industrial loads back then looked like this: high usage during the day, low usage overnight, weekends off. The grid could breathe. AI data centers break every one of those assumptions. They demand maximum load every second, No downtime, or no variation. When Oracle asks a utility for 20 to 50 megawatts of continuous power, the response is often blunt. We can't deliver that reliably, not without new substations, new transformers, new transmission lines, years of permitting. Utilities respond with timelines like 5 to 7 years. In AI terms, that's an eternity. The breaking point, why this is an existential threat. In AI, capability doubles every 6 months. Waiting 5 years isn't delay, it's extinction. This is why Oracle's revenue grew, but not enough. This is why customers are signed, but infrastructure lags. Larry Ellison openly stated that Elon Musk wanted far more compute than Oracle could power. Not procure, not build. Power. The same crisis is hitting Microsoft, Amazon, Google, Meta, all at once. They are all colliding with the same wall. Failed fixes. Why solar, wind, and generators don't work. So why not bypass the grid? Solar? No sunlight at night. Wind? Sometimes there is no wind. Diesel generators? Too polluting, too expensive, not scalable. Natural gas? Slow ramp times, poor load matching. Nuclear? Perfect, but takes 15, 20 years. AI needs a solution now. The real solution. Energy storage changes everything. What AI needs is energy buffering. Store power when it's cheap, release it instantly when needed. This is where flow batteries and zinc-based systems enter the story. Nickel zinc and zinc bromine batteries. Don't suffer thermal runaway. Scale to megawatts. Last decades, perfect for data centers. Companies are already deploying them, and this is where metals matter. The silver connection. Why 2025 changed everything. As of December 13th, 2025, silver trades near $62 per ounce, an all-time high, up 110% in 1 year. Why? Because silver sits at the intersection of solar panels, EVs, electronics, 5G, data centers. And 70% of silver comes as a byproduct of zinc mining. More zinc demand doesn't instantly mean more silver supply. Mining can't scale fast enough. The extinction equation. Why supply can't catch up. Demand, marker 1.4 billion ounces. Supply, over 1.05 billion ounces. Deficit, 500 million ounces annually. Inventories are collapsing. Recycling can't save it. Silver is being consumed, not stored. Once installed, it disappears for decades. Historical parallels when markets snap. Palladium, 15x, lithium, 12x. Silver has a larger market, multiple demand vectors, monetary history. A move from $62 to $200 is not extreme, it's conservative. Conclusion, AI is not constrained by software. It's constrained by electricity. Electrical bottlenecks create material bottlenecks. Silver is no longer just a precious metal. It's a strategic industrial resource. Final warning. You cannot print electricity. You cannot code around physics. You cannot conjure metals out of depleted mines. Oracle didn't miss earnings. Oracle revealed the future. If this analysis challenged how you think about AI, infrastructure, and markets, subscribe. Share this with someone who still believes tech is only software. And do your own research before the story becomes obvious to everyone else, because by the time Wall Street understands physical reality, the price adjustment will already be over.